So I wanted to talk about this trade I made with Weight Watchers and why I think covered calls are so powerful. So on February 21st, I bought 200 shares of Weight Watchers at $30. So on February 21st, over here, I bought Weight Watchers at around $30. And same day, I sold call options expiring March 15. So about a month out, a little bit less than a month out, at a strike price of 28.5, which is lower than my purchase price. But in return, I collected $3.60. So I actually collected more than the difference between 30 and 28.5. That difference is $3.60 minus $1.50. So I actually collected a $2.10 profit on a $30 purchase. That's 7% in a little bit less than a month. But then what happened is before March 15, the stock dropped 30%, all the way down to $19. So the stock ended up being lower than my strike price of 28.5. So I'm going to end up keeping the shares, of course, by March 15, and that's what happened. So I bought a stock at 30. My plan was to collect $2.10 of profit, but I ended up collecting the whole $3.60 because the stock actually dropped below 28.5. So yes, I own a stock that's down 30%, but I already got back $3.60 from it. So instead of actually owning a stock at $30, I actually own the stock at $30 minus the $3.60 that I collected. So my true cost is actually at 26.4. But my initial plan with the stock was to buy it at 30, let it get sold at 28.5, and I make a profit of $2.10. But because the stock dropped even further past my strike price of 28.5, then I can't sell the shares. They're not getting called away either. But I got to keep the full $3.60. So then for the following month, when the stock was trading at 19, I know that my cost is 26.4, but I don't want to sell it lower than my initial plan, which was 28.5. So I know I don't want to sell the stock lower than 28.5. And the only strike price that worked at that time was, so come March 15, I wanted to sell call options again. But the only thing that worked, instead of going to April 18, I had to go all the way out to May 17 to choose a $30 strike price and collect 15 cents. So the first month I collected $3.60 divided by 30. First month I collected 12%. But the second month, I was only able to get 15 cents. And it's not even for the second month, it's actually for 2 months out. So that's half a percent. The stock went from 19, started going back up to 21, almost 22, and then back to 20. So it's been trading between 19 and 21 for a while. And then all of a sudden, last week, it drops hard, drops back down, drops 11%, all the way down to 17.7. So when that happens, because usually when a stock drops hard from, let's say from 30 to 19 over here, usually it can go back up pretty fast as well, because there's a lot of movement. But this stock dropped twice pretty hard in about 5 weeks. So it looks like it's getting hit. So I don't think it's going to go back up anytime soon. So because of that, I decided to change my strike price. So instead of being at a $30 strike price, and the reason I chose 30 in the first place, because I don't want to sell my shares lower than 28.5, and there were no available strike options. The only one that worked was about 25, and I was afraid that the stock would go back up above 25 and then my shares get sold at 25. So I had to go all the way out to May 17 to pick a $30 strike price because I'm safe at 30. I don't want to sell the stock below 28.5, and I collected 50 cents. But now when the stock dropped all the way down to 17 last week, I decided to buy back the options that I sold at 15 cents. So to get rid of that obligation, and then change my strike price, sell another call option also at a May 17 expiry, but at a much lower strike price so that I can collect a higher premium. So here's the trade here. So I bought the option that I sold for 15 cents. I bought it back at 10 cents. So I closed that trade and I opened a new one at a 22.5 strike price. Also the same expiry date, but I collected 70 cents instead. So a much higher premium. So now my only risk is the stock cannot go above 22.5 come May 17. Because if it goes above 22.5 come May 17, then I risk losing my shares at 22.5, but I can only sell it at 28.5. But given the situation, I feel pretty comfortable that the stock is not going to go above 22.5 come expiry date, because it took 2 major drops in the past month, and earnings are coming up in the week of May 1st, so that's probably going to cause some movement. So last earnings the stock dropped hard, so maybe there's a slight chance that this earnings it might go back up, but even if it does, I just hope it doesn't go above 22.5. I don't think it's going to go above 22.5, doesn't look like it. but we'll see what happens. But I decided to take the risk in order to collect a higher premium. Based on the situation, I felt like it's not going to go above 22.5 in 5 weeks. So now that I collected 70 cents, that's a return of 2.3% for the remaining 5 weeks. So here's what happened. I bought a stock at 30, I collected $3.60, and then I collected 15 cents, but then I bought that back at 10 cents, and then I collected 70 cents. So now my true cost, so to break even on the trade, I have to sell the stock at 25.65. But I don't want to break even, or else all the past 2 months would be for nothing if I break even. But that number, it's so important to know what my break even number is, and that is 25.65. But since I'm actually trading in a margin account, I'm actually paying interest on this borrowed money. So I really don't want to just break even. The lowest I want to sell this stock at is 28.5, which was the initial strike price when I placed this trade in the first place, that allowed me to be still making money. So I don't want to sell the stock below 28.5, and I have the risk now that they get sold at 22.5, but I think I have a pretty good chance. Stock is trading at pre-market right now. It's trading at 18.25, and I have 5 weeks for the stock to stay below 22.5, and it got hit twice in the past month. So I think I have a pretty good chance that it stays below 22.5. But what I'm trying to show here is how I could benefit from a stock that's dropping. I could still collect money out of it, or collect an income out of it. So first month I collected 12%, second month was not even 0.5%, but I was able to change it and collect another 2% from a stock that dropped 30%. So that's really why I love, one of the reasons why I love writing covered calls. It always comes with the risk that your shares can get sold at the strike price that you choose. So that's just something you have to manage. But besides that, it's a very beautiful strategy. So if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250. And it is tax season, so if you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. And I'm starting this WhatsApp group for $10 a month, where I'm going to be sharing my trades live same day as I place them. So if you're interested, check out the description below. Thanks for watching.